Hi students, now that we have gone through the slides and gone through the lecture, let's look at the class example for this week. In this class example, it is actually a test that was given to students a few years ago. So you could expect something of a similar nature in a test or exam if financial statement analysis is tested. So obviously the first thing we're going to do when we get a question is we're going to read it and we're going to take note of everything given in the scenario because it could help us in answering the required. In this question, we have a person seeking investment advice. What is the significance of that? So obviously we learned in the lecture that a shareholder is interested in all aspects and stages of operation, profitability, liquidity, capital structure. So now we know what the person will be interested in when performing financial statement analysis. The company CVB is in the fashion retail sector. Why would they be telling us this information, or why is it important? Obviously, it's important to look at the sector in which the company is operating because it could signify certain things to us. When we look at the business risk of the fashion retail sector, sometimes fashion can be quite a risky business, and the reason for that is that if the economy is doing badly and households are short of money, they may not buy clothes or fashion. They may rather spend their money on food items and essential items, and they may cut their spending on fashion and clothes as it is not seen as an essential item. Another thing we need to think about in the fashion retail sector is the nature of the stock. Obviously, we are selling clothes. Think shorts, dresses, scarves, hats, swimming costumes. Every season, there's going to be new fashions and trends coming in. So this could have an obsolescence risk for old stock. If we have old summer dresses and now we're going into winter, it may be very difficult to sell that stock. So there is seen to be a high risk of stock obsolescence. And this could obviously come into play when we are commenting on some of our ratios. The scenario also mentions that CVB have introduced a new line of fair trade clothing. Often they will tell us key information in the scenario that is going to help us interpret the ratios later on. So it's very important that we take note of all of the information they are telling us. Also, what you'll notice in the scenario is that the ratios have been given to you, so you are not required to calculate these ratios. So the only thing you are required to do is to analyze these ratios. And the reason I wanted to give you an example like this is often students will focus on just calculating the ratios and they'll read through the analysis and they'll think to themselves, yes, of course I would have gotten that. So students often don't practice the analysis enough. So here, I'm fairly comfortable that you all know how to calculate the ratios, but I want you just to focus on the analysis for this class example. So they have given you the ratios, but they have also given you the statement of comprehensive income and the statement of financial position. So here you can actually see how the ratios have been calculated. They haven't just given you the final number or percentage for the ratio, they have shown you how they have calculated the ratios. And this is going to help you in your analysis of these ratios. They have also given you the share price in the scenario, and this could help you later on. So now we have looked at the information given in the scenario. Now let's have a look at what the required is. So the required is saying prepare a report on the financial performance and financial position of CVB. So once you are comfortable that you have read the required and you understand what the required is asking and you have gone back to the scenario so you know exactly what information is given to you, now you can actually answer the question. Before you start writing anything, it is good exam technique to plan your answer. So instead of just jumping into writing down every single thing that comes to your mind, I always recommend students to plan your answer and actually think about what you are going to write and how you are going to present your answer. So if you look at the required actually asks you to prepare a report. So you need to make sure in your answer you are doing a report format. If you don't, then you could be losing some marks for this. And obviously you're only going to do a report format because it was requested. If they didn't ask you to do a report format, then you would be wasting time time writing out the report format if it is not requested. So make sure when you read the required, you're paying attention to if they're wanting a memo, a report, an email, if they're wanting any specific type of format. So here we are going to do a report format because that is what is requested. Another thing we should think about is what headings are we going to use? Are we just going to comment on every single ratio separately, like your current ratio, then we're going to comment on the quick ratio? Are we going to just write one big paragraph, or are we going to try organize and split our answer in a logical format? What I would recommend here is actually having a paragraph per category of ratios. So comment on the liquidity in one paragraph, comment on the asset management in another paragraph, and comment on the debt management in another paragraph, and so on. Because often the ratios are going to link and they're going to talk to each other. So it's important when you're planning your answer to actually use paragraphs, and you'll have a paragraph for liquidity, then you'll have a paragraph for asset management. What I have noticed is sometimes students will comment on each ratio, so they will just repeat themselves. They will comment on the current ratio, then they'll comment on the quick ratio separately, and sometimes the reasons for why those ratios have moved can be similar, so the students will repeat themselves. So in this question, I would recommend commenting on the liquidity as a whole, and then moving on to the next category of ratios, which is asset management, and carrying on. So you should have a few nice big paragraphs. Remember when we did the lecture, we said that a good analysis must include the following steps. You are going to say what has happened. Here you are going to discuss how have the ratios changed. Then you are going to suggest reasons why. Okay, it is not enough to just say the ratio has increased or decreased. You actually need to suggest reasons why the ratio has moved in the way that it did. Sometimes the reason could be given to you in the scenario and you would have to use that in your answer. Sometimes you would have to just use your common sense and look at the numbers and give suggestions as to why the ratio has moved in the way it has. Then you're going to give likely implications. So here you're going to look at the implications of the analysis, and perhaps this could be going forward if a company has cash flow problems. If they don't address this, then the company could become illiquid and insolvent, or they could have going concern issues and not be able to pay their suppliers as and when they need to. After you have performed an analysis on the ratios, then you need to conclude on your analysis. Here again, so you will look at the ratios, the different group of ratios that you have analyzed, and here you need to conclude on your analysis. This could also be for a few marks. For you to gain the maximum out of this class example, you need to have actually done or attempted the class example, and then you can compare your answer to the answer that we are going to discuss. So please pause this video if you have not attempted the class example, and then come back when you are happy that you have answered it and attempted it, and then you can compare your answer to the answer here. The first group of ratios we're going to look at are the liquidity ratios. So what you'll see by looking at the liquidity ratios, particularly your current ratio and quick ratio, you'll see that CVP's liquidity has deteriorated from 2010 to 2011. We can see that in 2010, the current ratio was 1.96, and it has deteriorated to 1.75 in 2011. And the quick ratio has also deteriorated in a similar manner. It was 0.89 in 2010, and it has deteriorated to 0.61 in 2011. So here we have discussed what has happened, but now we need to suggest reasons why the liquidity has deteriorated. So if you think about your current ratio, what is your current ratio actually made up of? It is your current assets to your current liabilities. So here, if we want to suggest reasons why the liquidity has deteriorated, we actually need to break the current ratio and the quick ratio down. So when we look at the current ratio, we said it is made up of your current assets to your current liability. But what current assets does the company have? And we'll see in this scenario that the company has inventory, debtors, bank, and cash. So these are the current assets. And we would want to examine how each of these have changed from 2010 to 2011. By drilling down into the ratio, it will give us an indication of what what has changed. Did the current assets decrease? Did the current liabilities increase? What has caused the current ratio to deteriorate? So if we look at our current assets and our current liabilities, to assist us with our examination of why the current ratio has deteriorated, we can actually look at our average receivable days, our average payable days, and our operating cycle and cash cycle. So if we want to examine why our current ratio has deteriorated, we need to have a look at our inventory days, our average receivable days, and our average payable days. These ratios are going to help us to determine why our liquidity has deteriorated. So if we look at our inventory days, we'll see that our inventory days have increased. In 2010, it was 118 days, but now we actually have 167 days inventory on hand. So we'll need to think about reasons why our inventory days could be so high. One of the reasons could be perhaps we are expecting to make a large delivery to a customer. Perhaps a customer has placed a very large order and we are holding stock to meet the demand for that order. That is a potential reason, and you'll see this is mentioned in the solution. But one other thing we need to consider is that, like I mentioned earlier, because we are dealing with a company in the fashion industry, there's a high risk of stock obsolescence. So we are keeping inventory for much longer, and there's a risk that we may not be able to sell this inventory in the future. Like I said, fashions change. Perhaps most of this stock is summer stock and we are going into winter, meaning if we have it on hand going into the cooler winter months, we may not be able to sell it at all. And then next year when it's summer again, there'll be new fashions, there'll be new designs and colors in fashion, and we may not be able to sell the stock even then. So if we have an increasing number of inventory days, it is quite a significant risk for this company operating in this industry because it is fashion and there's a high risk that they will not be able to sell this inventory. If we look at our average receivable days, we'll also notice that this has increased. It was 55 days in 2010 and it has increased to 60 days in 2011. So if we look at our average payable days, we'll see that our average payable days were 110 days in 2010, and in 2011 our average payable days is 130 days. So this has increased quite a lot. One of the reasons for the likely increase in our payable days is that it could be linked to our inventory on hand. Perhaps we ordered a lot of stock, so we have a lot of clothing on hand, and we are waiting to sell that stock before we actually can pay our creditors. So that is one of the reasons why our payables could have increased. And although by paying creditors later, it actually keeps the cash in our business for a longer period of time, which can sometimes be seen as a good thing, we also have to look at other implications of not paying our creditors on time. If we do not pay them on time, we could actually destroy our relationships with them. We could have a bad reputation and they may not want to sell to us in the future. Another reason why our trade payable days could have increased is that we may not have enough cash on hand to pay our creditors. So if you look at the cash and cash equivalents figure in 2010, it is 9 million, but then in 2011, it has been replaced with short-term borrowings of 14 million. So in 2010, we had more cash available to pay our suppliers, but in 2011, we actually don't have any cash and cash equivalents sitting under current assets, but now we are relying on short-term borrowings. Perhaps the company does not have enough cash to pay its creditors, and that could be a reason why the payable days has increased. So if we look at our inventory and our average receivables making up the current ratio, you can see that those have increased from 2010 to 2011, but the trade creditors have also increased. The trade creditors have increased from 81 million to 109 million. So even though the current assets increased, our current liabilities increased by a greater percentage or greater proportion than the increase in the current assets. And that is why the liquidity has deteriorated. The increase in our current liabilities outweighed the increase in our current assets. Our operating cycle is made up of our inventory days plus our average receivable days. So as you can see, our operating cycle in 2010 was 174 days, and in 2011 it was 228 days. So our operating cycle has increased. And the reason for that was the reasons we discussed for the increase in the inventory days and the average receivable days also increasing. If we look at our cash cycle then, so our cash cycle is made up of our operating cycle minus our average payable days. So even though our operating cycle increased from 2010 to 2011, this increase was set off by the increase in our average payable days. So the next group of ratios we're going to look at are asset management ratios. Here we have our fixed asset turnover ratio and our total asset turnover ratio. Both our fixed asset turnover ratio and our total asset turnover ratio have weakened from 2010 to 2011. If we look at our fixed asset turnover ratio, we'll want to know what is the reason that this ratio has weakened. So here we will answer that question by actually looking at what is the ratio made of. We need to dig deeper and we'll see that the fixed asset turnover ratio is made up of our sales revenue divided by our fixed assets. If we look at our sales revenue, we can see that our sales revenue has increased by 10% from 2010 to 2011. But if we look at our PPE has increased by 20%, meaning that the increase in our PPE is greater than the increase in revenue. So this explains why the ratio has weakened. Even though our revenue increased, the increase was less than what we would have expected for our increase in PPE. If we look at our total asset turnover, we're going to calculate this ratio by taking our revenue and dividing it by our total operating assets. So our operating assets would be made up of our PPE and then our current assets. You'll notice that they have not included investment in associate in this ratio, and the reason for that is that an investment is part of the investing activities of a company. But here we are looking at the operational efficiency. So we cannot include an investment balance in our assets because it is not an operating asset. We are only interested here in assessing the operational efficiency of our assets and the return that those assets are generating. So here what we'll see is that our revenue has increased by 10%, but our current assets have increased by 35%. So even though revenue has increased, our fixed assets increased by 20% and our current assets increased by 35%. So remember we discussed previously the inventory days and the receivable days and those corresponding balances. These balances are included in our current assets here, and this would be one of the reasons why our total assets is increasing. So even though sales increased, the increase in your current assets and fixed assets here are greater than the increase in sales, and this explains why there is a weakening of our asset management. So as we can see from these ratios, there is weaker management over our current assets. So our inventory is not being sold, it is being kept on hand for longer periods of time, and our debtors are being paid much later than they previously were. So as a result, the increase in the value of these assets has not yielded an immediate return, as can be seen from the increase in our turnover. If we look at the next group of ratios, our next group of ratios comprises our debt ratios. So here we want to assess the management of debt, and we are going to do that by looking at our debt ratio, our debt equity ratio, and our times interest earned ratio. As you can see, our debt ratio has marginally increased from 45% to 46%. And what would the reason for this be? So if we look at our debt ratio, you'll see that it is made up of your debt to your assets. So if we want to look at the reason why our debt ratio has increased, we will have to drill down and have a look at what is the ratio made up of. The ratio is made up of your debt divided by your total assets. So as we mentioned previously, our total assets have increased, and this is as a result of the increase in our PPE and the increase in our inventory balance and our debtors balance. If we look at our debt, we can see that our long-term borrowings have actually decreased. And we'll want to ask the question, if our long-term borrowings have decreased, why is this ratio actually increasing? So if our long-term borrowings have actually decreased, meaning we have paid a portion of this long-term debt back, why has our debt ratio increased? And the reason for that is that we have short-term borrowings in 2011 of 14 million, which we didn't have in 2010. In 2010, we had zero short-term borrowings. So not only do we have short-term borrowings in 2011, which is increasing our debt ratio, but our trade and other payables have also increased from 81 million in 2010 to 109 million in 2011. So essentially, our long-term debt has been replaced by our short-term debt, which has resulted in an increase in our debt ratio. Short-term debt actually has a higher risk than long-term debt because the payments need to be made quicker and the interest is likely higher on the short-term debt than on the long-term debt. So this actually increases the financial risk of the company. And if we look at our times interest earned ratio, we'll actually see that that ratio has deteriorated from 8 times in 2010 to 5 times in 2011. This ratio shows the number of times that your earnings covers the interest expense. In 2010, our EBIT covered our interest expense 8 times, whereas in 2011, our EBIT covered our interest expense only 5 times. So despite the EBIT being the same, being 40 million for 2010 and 2011, the interest expense has actually increased. So in 2010, our interest expense was 5 million, but this increased to 8 million in 2011. So despite us paying back a portion of the long-term debt, because we replaced that long-term debt with short-term debt, our interest has actually increased. So there could be a possibility of the company raising more long-term debt in the future, but because the times interest earned ratio has deteriorated, it could be concerning to a potential lender. A bank will obviously do its own analysis on the company's financial statements, and it could see that the times interest earned ratio and the other debt ratios have deteriorated. Therefore, they may not be willing to lend to this company, or they would be willing to lend at a higher interest rate. If we look at the next group of ratios, being the profitability ratios, we can see what is happening with the profitability of this company. So if we look at our gross profit margin, we'll see that our gross profit margin in 2010 was 35%, and this has deteriorated to 33% in 2011. Obviously, we need to drill down into this ratio to assess what has resulted in this deterioration. This ratio is made up of our gross profit divided by our revenue. So we can see that our gross profit in 2010 was 144 million, and this actually increased in 2011 to 148 million. And then if we look at our revenue has increased. If the rand value of our gross profit has increased, why has this ratio deteriorated? If you look at the percentage increase, we need to compare the percentage increase in our cost of sales to the percentage increase in our sales. If we do that, we can see that our sales increased by 9.9%, whereas our cost of sales actually increased by 13.8%. So our cost of sales increased by a greater percentage than our increase in sales, which is slightly worrying. What could the reason be for this? So why would cost of sales increase more than the increase in revenue? One of the things they told you in the scenario was that the company has just introduced a new line of fair trade clothing. So if they have introduced a new line of fair trade clothing, it means they have changed their product mix. So the company has changed its product mix. They have introduced the new fair trade clothing line, which means they have increased their cost of sales. They have spent money making this fair trade clothing, but they have yet to generate the revenue from that clothing. Hopefully in the future, the fair trade clothing line will take off and the revenue will hopefully increase in line with the increase in cost of sales. If it doesn't, the company could have problems in the future with its profitability. So the operating margin and the net profit margin have fallen in line with this. The return on equity has also dropped from 16% to 12%. So in 2010, we had a return on equity of 16%, whereas in 2011, our return on equity was only 12%. What could the reason be for this? If we look at our return on equity, we'll see that our return on equity is our net profit divided by our equity. If you look at your statement of comprehensive income, you'll see that our profit before interest and tax was 40 million in both 2010 and 2011. So if you want to assess what is the reason that our profit has decreased, the reason is that there has been an increase in the finance costs, and there's also a share of loss of an associate in 2011 that was a profit in 2010. So the profit is actually being reduced. So the reduction in our profit coupled with the increase in equity has resulted in a deterioration in the return on equity ratio. So overall, it looks like the profitability of this company is declining. And if they don't address this in the near future, there could be problems. Obviously, a company needs to be profitable, otherwise shareholders will not want to invest in this company. The next group of ratios we're going to look at are market value ratios. We have our earnings per share in 2010 of 83 cents, and this has decreased to 77 cents in 2011. Then we have our PE ratio, which has gone from 10 in 2010 to 6.52 in 2011. Another thing we need to look at is the share price. They also told us in the scenario that the share price has dropped by 40% in the current year. So why would the share price drop? If our earnings per share is deteriorating and our PE ratio is deteriorating, people will be prepared to pay less for the share this year than they were last year. So that is a reason why the share price has decreased. We also need to compare the net asset value per share to our market value of our share. So in 2010, our net asset value per share was 5 Rand 20, whereas the market value of our share was 8 Rand and 33 cents. So the market value of the share there is higher than the net asset value per share. Whereas in 2011, we'll see our net asset value per share is 6 Rand 40, but our market value per share is only 5 Rand, meaning our net asset value per share is actually greater than the market value per share. This gives an indication that the market is not really happy with what is happening in the company. Now that we have analyzed the different groups of ratio, we need to conclude on the scenario. We need to conclude on the required. So here we'll see, after analyzing the financial performance and financial position, the company may be experiencing problems, and the person who is wanting to potentially invest in this company may need to consider certain things we have just seen in our analysis. So we can see in the analysis that the company is moving to incorporate a fair trade clothing line in their product mix. This indicates that the company may be revising its strategy because they are aware that in the long term they may not be sustainable. So they are planning on changing their product mix and introducing the fair trade clothing line in the hope that this would result in sustainability of the business in the long term. As we have done this analysis based on the 2010 and 2011 results, the benefits of this revision of strategy may not be evident in the ratios we have just analyzed, as we have just looked at the short-term results. So the investor should be aware that even though the short-term results may not paint a good picture of the company, they have made a move to change their strategy to hopefully ensure long-term sustainability of the business. We also saw that the company may have short-term liquidity and cash flow problems, and this could result in going concern problems if it is not addressed in the near future. So from an investment perspective, based on the analysis of the ratios we have looked at, the short-term liquidity and cash flow is an immediate concern, and it could constitute a going concern risk if it is not addressed soon. In the long term, the strategy adopted may assist with the going concern risk if it is able to generate revenue and profit and cash flow. In the long term, the strategy they have adopted of introducing a fair trade clothing line will hopefully be enough to ensure the sustainability of the company.